Hello, good morning. I see some people are starting to join in. Just a reminder that we have a great presentation for you today. And we're going to get started in a few more minutes. We're going to give some more time to people that are still connecting. So just stay tuned and we'll get started soon. All right, I'm just going to give another minute for people that are still trying to connect, and then we'll get started. I appreciate everybody's patience. All right, that should be enough time. We'll kick things off now. Hello, everyone. My name is William Mucker. I'm a client executive with Camaplan and would like to thank you all for joining us for today's webinar, Charting the Course, 40 Years of Commercial Real Estate Investment Insights with Forterra Investment Partners. As a quick note, please be aware that we'll be answering questions at the end of the presentation. However, feel free to use the chat and/or Q&A function on your screen to pose your questions whenever they cross your mind. They will be saved and addressed once the presentation portion ends and the Q&A portion begins. Before we get started, we have a brief disclosure to go through. Everything presented in today's webinar is strictly for educational purposes. Camaplan is a neutral third-party administrator of IRAs. We are not attorneys, CPAs, or financial advisors. If it comes to a time where you need advice in any one of those fields, we highly recommend you consult with your team of professionals. We are more than happy to be a part of the dialogue with your team of professionals to make sure the investment process is quick and seamless. We do not sell any investments at Camaplan, nor do we endorse any products. We will never call you about the next best investment opportunity. We believe that you should always do your own due diligence before investing your money, whether it be your retirement funds or otherwise. Once you have found the investment that is right for you, we will help you open your account, fund that account, and facilitate the transaction into that investment. Here is my contact information. If you or anyone that you know who you believe can benefit from the information have any questions about what is discussed in the presentation today and how it applies to self-direction, please do not hesitate to contact me. I'll be more than happy to help. And without further ado, I'll pass the controls over to you, Mike.
Yeah, perfect. William, thanks so much. We really very happy to be here, and we really appreciate Camaplan for allowing us the opportunity to share a little bit of the knowledge that's been gained over the years. So again, my name is Mike Mendoza. I'm primarily focused on business development at Forterra. Prior to, I was a Marine Corps captain, and also got my MBA over at CU Boulder. So without further ado, we will go ahead and kick off the presentation. So we are going to be leading a conversation today with Dan Markee. He's going to be giving a lot of insights from the past 40 years of experience that he's had in commercial real estate investments, primarily focused on the 6 real estate cycles that he's participated in, as well as opportunities and pitfalls of a down cycle, and how you can kind of really take advantage of those opportunities. He'll also be discussing the keys to selecting real estate investments at any point in the cycle, particularly as an individual investor, as well as where to invest today. We welcome any questions, and please go ahead and put them in the chat or in the Q&A, and we'll be more than happy to address them either throughout or towards the end of the conversation. So without further ado, I'd like to introduce Dan Markee, founding partner of Forterra Investment Partners, and hand it over. Dan?
Great. Thanks, Mike. Yeah, very happy to be here, and thanks to Camaplan for allowing us to speak with you today. Before I kind of kick this off, I want to, Mike mentioned his having been through the CU Boulder Real Estate MBA program, and I want to make a shameless plug for that program as both an alum and a board member, that if it's one of the most robust real estate education curriculums in the country, and so I just throw that out for anyone's consideration. So Forterra, I formed Forterra with a partner in 1994, having spent a period of time, roughly 7 years, with a life insurance company, and we'll touch on that in a moment beforehand. But what Forterra has done through its inception is identify investments in real estate, have sourced capital through family offices and individual investors over a very long period of time. We're very happy to say that we still have our original investors investing with us after all these many years. We don't do funds. We invest on a property by property basis for a couple of reasons. One is that we think that if you have a fund, you are more likely to invest over the top of the curve when you should probably be pivoting to something else. But also because we just frankly don't like to spend that much time dealing with the SEC. But in any event, we're real estate type agnostic, geographically diverse. I've worked on projects in, I think we are something like 46 or 47 states at this point, all different property types, and we like to focus on the things that make a lot of sense to invest in the period of time that we're currently investing. So that's Forterra. As I mentioned, prior to Forterra, I spent 7 years at a life company where I was in charge of the department that was doing workouts of troubled real estate partnerships, which, if you think about it, was a great education for what I'm doing now. And I also, as part of my mandate there, was negotiating settlements, working kind of as the good guy, bad guy routine. I was the good guy with borrowers during mortgage foreclosures to see if there wasn't an arrangement by which we could work that out short of the courts. That was a great experience, and from there was the springboard to the creation of Forterra. When we originally started, we had German capital. We ran around the country and bought office buildings during the RTC era, and later sold all those assets. And really, from that time forward, we've been focusing on joint ventures with operator partners, where we're very active investors. We are not passive investors in projects, and have enjoyed that work very much. The workout piece of this created a toolbox, if you will, that I have, and a whole number of lessons learned that we're going to touch on today, as we're at an interesting point in the economic cycle for real estate and for the economy in general. So with that, we'll go ahead and kick off the next aspect of this.
No, that's fantastic. Thanks so much, Dan. Really appreciate you giving that overview of your background. I know one of the things that we really wanted to highlight during our time together was, can you give us a little bit of historical context on the real estate cycles that you've experienced, and then your thoughts on the associated macroeconomic perspectives.
Absolutely. So it's like all things are the same, and they're always different. It's kind of is the short sum of that. So there's a graph up here that shows economic cycles as measured by unemployment. That the top portion of this slide, and that's really interesting, especially as we're sitting in a position today where unemployment is not a good measurement of where we are in the economic cycle, and we'll touch on that in a minute. But I think it's helpful to kind of look at a couple of trends over a long period of time with respect to down cycles, and this is illustrated well here. There are a number of things that are obvious when you're looking at down cycles and how they were triggered. So good examples of that would be wars or warlike events like 9/11. Clearly that those events going back to the 50s, you can see here, all have been a catalyst. Supply chain disruptions of one kind or another is another triggering event, which was very obvious at the time. So think of the oil embargo during the Carter administration, or more recently, all of the supply chain disruptions that were created by COVID and all of the events surrounding that point in time. Another thing that has been a trigger over time has been institutional failures. And by that, there's some real obvious examples. So think Bear Stearns, Lehman Brothers, Washington Mutual, all failing within a relatively short period of time, all related to the holdings that they had with respect to subprime loans. We're going to touch on excesses in a minute, but that is a great example. So stock market crashes, if you think about that as a trigger to down cycles. So think about the dot-bomb crash as a good example of that, and really more recently, the stock failures of Silicon Valley Bank, Signature Bank, and so on. Again, because in an environment where there was a lot of capital supply, they got further and further out in terms of risking their capital within a relatively small segment of the market, high tech. And again, they only have to look back to the couple of cycles previously and the dot-com bust to understand that's a very cyclical place to be. And then the last would be capital constraints as a trigger for down cycles. So if you think about the Russian currency crisis, for example, which takes you back to the late 90s, which was an international event that happened because one country had a crisis in it, and it dominoed throughout the world's economic systems. Another really good example of that is the recent interest rate increases that we've seen created by the Fed increasing rates as a reaction to very sudden onset of inflation. So that those things were very obvious. What's interesting to me is the things that are only obvious with hindsight. So I chuckle at people who say, gee, Dan, you should have known about one of these cycles, and you should have seen it coming. Well, the fact is that people don't see things coming. They don't see coming what can't be envisioned. And there's two, in my way of thinking, there's two things that happen. One is what happens in the markets themselves, and then the coupling effect or the compounding effect of government policy, particularly when there's social engineering attempts that are related to that, because there's two results of those things, and I'll show some examples in a minute, but one of them is you get a lengthening of cycles as a result of this, and you have a plethora of unintended consequences because all of these economic interactions are so complex. And if you're focused on one aspect only or a couple of aspects, if you're trying to create policy, it's very hard to contemplate what the unintended consequences are. So a couple of really good examples of that. The 1986 tax law change was very sweeping in its changes to incentives and disincentives for companies of all different kinds, particularly those who were regulated. And on one hand, life insurance companies, which previous to that change had been the largest patient holder of real estate assets in down cycles. And after that 86 tax law change, they were penalized for holding these distressed assets, penalized by having to have additional reserves against them. That unintended consequence had a huge ripple effect through making cycles, starting really with the kind of the S&L period, making those cycles much more severe than they needed to be or would have been prior to that tax law change. Another example as a result of the tax law change in 86 is that at the same time they were penalizing the life companies, they gave a green light to the savings and loans to leave their previously restricted lending operations at home loans and allowed them to make commercial loans. And we all know what happened. That's what eventually brought about the Resolution Trust Company and the failures of many savings and loans, either by just financial failure or takeover by the government. But again, unintended consequence as a result of policy in that particular case, and which led to excesses. And the excesses here is they were making a lot of money in those S&Ls by making commercial loans, and they made a lot of money making loans that should have never been made at all. And they were neither equipped in terms of human capital or systems to understand this whole new product type that they were launching into. And we all know what the outcome of that was. So another good example of unintended consequences relates to the kind of unmonitored securitization of home loans that led to the Great Recession. And in this particular case, on paper, there were gatekeepers that were supposed to be watching what was happening. But the net effect that there was no person or group of people who were responsible for owning these loans after they were made. Once they got securitized, the people who ran these securities were relying on the rating agencies, and the rating agencies were approving everything in order to get it done because, again, they were making great money during that period of time. I happened to, the other night, I rewatched the movie The Big Short. And if you haven't seen that before, haven't seen it in a while, there are a lot of lessons in that period of time that are shown in that movie that are applicable today. And I would suggest the audience here take another look at that movie if you haven't, because we create the same problems in one fashion or another. We don't seem to learn from our mistakes. But during that period of time, you had both banks and non-bank lenders who were generating loans that they just threw away all of the credit rules of lending. No job loans, no credit, up to 125% of home value, which, as an interesting kind of sidelight, how did they ever justify a 125% loan? on the value of your home. The logic with the underwriters and the rating agencies was that historically, you had a first mortgage, you had a second mortgage, and you have credit card debt, all that any family might have. And their theory was if we pile those all up into one loan and put them on the house, because homes, people will fight to the end to not lose their home, that they were going to be able to rate those pooled credits at various tranches higher than if they were independent, that is, a first loan, a second loan, and credit card debt. That's how they justified it. Of course, what happened was, and common sense would have dictated that as soon as they had that loan, they went out and ran their credit cards up again and ended up way over the top. It really got crazy when the government, in the form of Freddie and Fannie, got into the subprime lending business. So they got into that business because three people got in a room in Congress and said, if we can make more loans to underprivileged people who happen to, by the way, these were all happen to be Democrats, and I'm not speaking to politics here today, but I would tell you that it's pretty clear what they were trying to do was put more people into homes that would vote for them, for their party. And their goal was to increase home ownership by 5%. They actually exceeded that. Home ownership grew by 6%. And that sudden new demand that was created because these loans were being made had a whole bunch of unintended consequences, including home values soared. And as home values soared and money was plentiful, people would refinance their homes and reinvest in more homes and in the stock market, as it turned out, with the proceeds of those loans. And everything kept spiraling and spiraling to the point that when it finally stopped, you had a 30% decrease in the stock value. That was about the run-up during that period. So it eventually found its equilibrium. And almost to a one, the 6% of home ownership that was created by policy here, both by lack of policy and by the government getting involved into this, the unintended consequence there, all of those people that got those homes, almost to a one, lost those homes. And that's the supply that was the foreclosure supply that happened and drug on and was the creation of the Great Recession. It's important to know these things, to think about these things when we're talking about real estate today, when we're talking about how does what's going on in the world affect what we're doing, and how these cycles are playing out. Of one of the events, a couple of things that happened as a result of these various different policy and capital events is that, and if you go back to this this graph that you see here, it's pretty obvious that the cycles are extending. They're longer. So what used to be, and again, I go back to the Great Recession. The run up to the Great Recession took what would have been historically a 6 or 7 year real estate cycle in normal cadence and stretched it to a 12-year cycle because of the supply of capital, simply because of the supply of capital. And then as a result of that, ever since that, we've been out of sync. Our periods of run up and run down are extended, they're longer. And as those cycles extend, one needs to be aware of that when they're considering where we are in any particular cycle. But the graph that should be laid over the top of the graph that you see here is one that says where were real estate values, for example, or the stock market as another example. And it's exactly countercyclical to these lines of unemployment. Now, a very different thing happened when we got to the current period of time, and we'll touch on that in a moment, as it relates to the lengthening of cycles, and particularly the unemployment as a measure of an economic cycle. But so we have these longer cycles. We've had a long run up, for example, in apartment supply. Has that been too long? It's been, it seems to be cooling now and finding its equilibrium on a market by market basis. Yet we still have a shortage of housing in the United States. So you have these conflicting data points. And I always say that longer cycles equal excess in supply and the perception of greater value. Well, that is all things being equal, but all things aren't equal. There is a real shortage of housing in the United States, and it was certainly amplified by the COVID disruptions to supply chains, and we still haven't kind of worked through that. There are changes in the United States that are undeniable. So, for example, industrial distribution space demand continues to grow. That is really driven by e-commerce and data centers. So if you think about data centers as being, two big compelling issues right now that are driving that even more than it was before, is AI computing and crypto mining, both of which take massive amounts of power, and power becomes now the inhibitor to growth in those particular spaces. Anyway, I could go on forever about the general economic cycles, but what I've seen over these many years, and like Mike said, over the last 40 years of investing in real estate, so obviously I started when I was 8 years old, is that some things are always the same and some things are never the same, and people who think they can pick which is which are really the rare birds. That really doesn't happen very often.
Dan, and that's a perfect segue. Thanks so much for all that historical context. And one of the things that you mentioned was that, hey, hindsight is 2020, as well as all of these complex, macro trends and macroeconomics. How are they all interconnected, and how does this relate to real estate investing today in regards to where we are in the economic cycle?
Sure. Well, yeah. So there were some data points. Now, how do we apply them in making investments? And I think the first thing we need to do is kind of recognize what is out of balance and what is a kind of a new reality. What is the difference between those two? And I hold out that COVID, when we look back historically some years from now, we're going to see that COVID was maybe the most pivotal change event in my lifetime, for sure. I mean, more than things like the invention of the cell phone or the personal computer. And why? Because it really showed us just how we were exposed we are in terms of our human vulnerabilities to things around us that we can't envision and that we can't change. And in the case of COVID, it's a very interesting case, but in my view, our government reacted really well to this in the expenditure of about the first $2.5 trillion. They supported job stability, they supported industries, both to keep the trade moving, to keep people employed, and they really funded the creation of the new vaccines that brought us through this thing and saved tons and tons of lives. And in my view, personal view, that was really well spent money. Then came the second $2.5 trillion. Now, at this point, what happened was it became, instead of something you had to apologize for as a politician, it became something you could run off of. It became expedient to expend more and more and more money. And the interesting thing about the second $2.5 trillion is it hasn't been spent yet. It's still out there. It's still finding its way through bureaucracies and systems at all levels of government and all levels of programs that industries can take advantage of, but it hasn't been spent yet. And it will trickle into, into the economy for years to come. So we think about COVID and we think about, gee, it happened to us really fast and then it was over and then it was over really fast. Well, it's not over really fast. It was a steep curve. All of the effects of COVID happened very quickly to us. The curve coming down off of it isn't a steep curve. It's a long, gradual run. And what's happening is these things will trickle through and have effects in our lives, our daily lives, for decades. So think about things like education and what happened to the students during that period of time that kind of missed whole periods of time. Think about people who were young people and trying to enter various industries, young professionals, let's say, I'm going to use lawyers as an example, where they had to work from home. And they didn't have the ability to be mentored face to face by the senior members of their firm, those kinds of things. All of those kinds of things. I have a son who spent COVID going through medical school, much of which was spent online, and it wasn't the same experience. So you have those kinds of real life events that happened to us during COVID that are going to run through. The interesting thing about this $2.5 trillion, again, and this is, in my opinion, is the reason that we're seeing an event today where we had very high, rapidly moving inflation that was not coupled with unemployment. It is really largely because this $2.5 trillion, it will continue to support aspects of the economy for a long time, and as a result of that, keep people employed, even though we clearly are having major down cycles in a number of different industries. Anyway, so I think that we need to be mindful of where we are in that balance. COVID was a catalyst for a whole bunch of great innovation. So think about the Zoom call we're on right now, for example. We probably still wouldn't have it if it hadn't been for COVID. All of the RNA vaccines and all of the things that are coming out of that technology that was created because the government saw fit, and I think appropriately, to spend money on getting those things done and done fast. But it also spurred revolutions of a different sort. So think about stay-at-home workers. There's a famous saying, luxury once enjoyed becomes a necessity. And that certainly seems to be the case with people who, after a year and a half or 2 years of working home said, why would I ever go back to my office? And if they're going to make me go back, I'm going to find a different job. And that's precisely what has happened, and why the return to the office has been stunted, because the employer, with low unemployment, the employee still has the power in the conversation right now. In the future, that pendulum is going to swing back. And I happen to be a believer that this is probably, if not the best, the second best time to invest in office buildings in our history. People will have to go back, but what's going to happen is, and I think this is interesting as well, the data now, we think about these things in lump sum. That is to say, everybody wants to stay home, or everybody wants to do one thing or the other, or people are more efficient when they're working from home. And the data is not bearing that out. In fact, what's happening is it's being bifurcated. That is to say, they're learning right now when working from home can be efficient, in what industries and what job types, and how that can support certain activities. And they're also learning, to a greater extent, actually, from what I've read, that that the opposite is true. That there are a whole bunch of types of work that are supposedly being done from home now that are not nearly as efficient. So a good example of that is right here in Philadelphia, where I'm sitting today. City of Philadelphia has done a study and realized that their city employees that are working from home are rarely even logging on to their computers to work. It's just not efficient, because they don't have to, and they're not measured in a way other than, kind of bureaucratic. And so as a result of that, the new mayor in Philadelphia has dictated a timeline by which all city employees must return to the office, both because of those efficiencies, but also to support the invigoration or reinvigorations of the downtowns in this country. So I think we'll see more of that as that data comes to play. The other thing I wanted to kind of shift to was, and Mike, to your question about real estate, where are we in the real estate cycles and leading to where and how we can invest, is that it's not one cycle. It's a whole bunch of cycles. That is to say, by property type, by location, by submarket, by age of asset, by any number of things. And back in the when I was doing all those workouts for the Life Company, I actually had a chart that I had created that showed office space as an example in like 15 different markets. They all had the same shaped curve. Some were a little steeper in terms of their distress and their recovery. But they were at different points of time. It was the same event over different periods of time, over a long period. And what you see in graphs like the one that's in front of you right now are averages. But this is by segment. So if you go back to the Great Recession and you see, this is CMBS delinquencies. So yeah, go back one, Mike, for a second. Let's stay on that. Oops, no, not that one, the other one. No, the other way. One more then, I guess. Yeah, okay, that one, the one with the colored lines. Go up one. Yes, thank you. So if you look at this chart, what you see is, looking back at kind of where it says January 2020, and you're looking at, if this stretched back further, you would see as we went back to 08, 09, a very similar kind of curve in terms of delinquencies, except much higher. And what you see here is you've got 2 or 3 or 4 property types that really aren't experiencing something out of the norm. And that it's really, in this case, it's as of 2020, it's office and lodging. Well, why? Well, this is all related to COVID, the things that kind of shut down. Retail was also greatly affected. If they could somehow show you here, so this is CMBS, but if you looked at retail sales, the sales over that same period of time would be flatter. Why? Because people were moving from brick and mortar acquisitions of goods and services to buying things online. And I think that trend will continue as we see all new, I can't remember the last time I went to a grocery store because they delivered to the house. So those kinds of things change the way that we behave. But when you look at the very tail end of these graphs, and you can see the hint of some trend, excuse me, and you see there that multifamily is starting to tick up a little bit in terms of deficiencies. We'll talk about that in a second, but But on the whole, these delinquencies aren't at an emergency level, but we look forward to where what volume of loans, again, using CMBS as the model, what do the expirations look like, and what's starting to bubble into those cores? So what we're seeing in markets throughout the country right now, for example, is very healthy product. So let's use apartments, multifamily projects, recent builds. Let's say that they were finishing construction recently when the interest rates started to change, or they were in their lease up. And what happened is that their whole pro forma for their projects changed. And in many cases, the developers are out of the money. That is to say, because of the change in cap rates and interest rates, they're really never going to make any money on these projects. And much of the equity on those could be at risk if you were in the wrong project at the wrong time with the wrong debt. And this is particularly comes to the fore. You don't have any losses until there has to be a transaction. And where does the transaction occur that causes losses today? It happens because your loan is rolling. And if you've got a construction loan and you're coming up to the end of your loan, and perhaps you're a developer and you've got some personal guarantees on that loan, maybe you don't, but in any event, what you have is you have a transaction that needs to happen because that lender's not going to return the loan, just not going to roll that loan over if they're a bank, and certainly not CMBS, because there's frankly nobody to talk to. So the stress in transactions that's happening right now, the distressed opportunities, are happening because of loan rollovers, as more than because of the change of demand, with the possible exception of office. And I'll give you one example of that. There's a lender of a major bank who has a major position in Portland, Oregon. And Portland, Oregon, the core office buildings, it's not a huge city, but their core office market got hit both by a coincidence of tenants leaving the core of downtown because there was a lot of disruption during COVID and since then in the city itself. And so people were fleeing to the suburbs. And in addition, you have 80% of those towers in downtown Portland were financed 10 years ago with CMBS, and those loans are all rolling. They're all rolling this year and next year. And there are no tenants for that market right now. So that's a good example of one where there clearly is going to be a bloodbath in the short run. When we're looking at where we are in the cycle now, it's healthy to take a look at kind of these current loan delinquencies versus, I would say, the Great Recession as a bench point of how bad things can be. And what you would find is we aren't there yet, and we certainly aren't there with any product type even close to that level, with the possible exception of looking forward in some markets to what's happening. I'd say Portland, I'd say San Francisco, I'd say Washington, D.C., where there's going to be some serious distress. The other thing I would say is that it's important to remember that down cycles are healthy. It's kind of like burning dead wood in a forest. They're very important for us to have normalized cycles that we can rely on over time, that are measurable in a fashion where we can kind of see and predict where we are in the cycle. We haven't been able to do that because we got out of sync with the length of these cycles because of both financial and policy engineering, in my view.
No, that's great. Thank you so much, Dan. That's a lot of considerations to keep in mind. So I'm curious, what insights you can share regarding where and how to invest in real estate today, particularly for our audience today, with a focus on individual investors.
Yeah, so bringing it all home, as you might say, the key aspects of investing today really don't change. That is to say, diversification is the first rule. If we've learned anything at all over these last cycles, is we can't see what's coming and what's going to affect us. And by the way, it's almost never one item, one issue that causes things. It's usually a confluence of 2 or 3 things that happen. You know, where were we at the cycle when 9/11 hit? Plus, we had something else happening, and all of those things happened simultaneously. And when it was really the confluence of those things that caused issues at that point. Same could be said for COVID and the things that kind of rolled out of COVID. But then you also had things like the race-inspired riots in Minneapolis and many other cities related to the unfortunate event there in Minneapolis. And there are things that compound economic issues that are social and hit us close to home. So again, I go back to diversification. You want to be diversified with respect to where you're investing, both in and out of real estate, and inside of real estate. You know, different markets, different property types, and you know, don't get too much of your investment in a single bucket. That's one of probably the greatest lessons over time that are amplified as we look back at these down cycles. The other thing I would say is invest in people first. Product and markets, product type, the real estate project itself second. And because at the end of the day, these are all, events that are related to people that have to execute. And people that, even though we have lots of long documents in any given transaction, it's more about the integrity of the people, their experience, and their ability to not only deal with things as they come, but maybe even anticipate them. So the very best operators that we partner with are people who, and perhaps with a little help from us, can look around some corners and say, I don't know if this is a problem, that this could be a problem coming at us. And the one thing that I've learned in my years as a workout artist is the earlier you identify a problem, the more opportunities for solution that you have, and the more that you apply the ostrich theory, the fewer you're going to have, for sure. When one other suggestion I'd have here for you here is, I always invite people in our deals and would suggest that anyone looking at any investment is challenge the pro formas. Look at things on, is it an optimistic underwriting? Do all the stars have to line up and for you to get that return? Otherwise, it's going to be less. What's the base case? What's the optimistic case? What's the reasonable downside, short of Armageddon downside case? Those are the ones that I want to look at. But I would also suggest, and we do this, is that we want to say that we've priced our investment, what we're buying into a project, at a point where we have as much opportunity to outperform as to underperform. And that we're sitting on the top of some bell curve relative to performance, because there's one thing we know about performance, that is the one single set of numbers you'll never see. It's either going to be better or worse or different, but it's not going to be that set of numbers. It's just there are too many variables. And I would also suggest that investors insist on seeing a sensitivity analysis. So it's not just only where are we on that curve, if you will, in terms of downside versus outperform, but also how steep is that curve? That is to say, does 50 bips of cap rate take half of your return away. And even though it's very exciting on the other side of that curve, if it's a very steep curve, one has to recognize the risk that you're taking. At the end of the day, we're buying and selling risk. And what we do as a firm is we try and invest into projects where we think that we have a reason that we can manage the risk as well or better as anyone. And, you know, that's, I think has been key to the success of our firm. Couple of other just quick thoughts, and then we can kind of wrap this up and take any questions, is I would suggest, particularly for individual investors, to not sit on your hands during the down cycle. This is when you're gonna, if you've picked the right people and you've really taken a look at what you're buying into, this is where you'll make your best buys. That being said, don't chase the rainbow. That is, you're going to see a lot of press because it's easy, sexy press to write about buying distressed assets and so on. I will tell you, in our last cycle, the 08 cycle, there was so much capital that was created to buy distressed assets that was sitting on the sidelines waiting for that to happen. I know, I created some of it. Unlike what happened in the Great Recession, where there were very few of us out there just buying stuff up, the distressed stuff never hit the market in the last, for a couple of reasons. One is banks had a lower percentage of debt, and there was more equity in the deals, and so people worked through those. And in the middle of that program is when the apartment boom started, and a lot of those assets were apartments, and they worked themselves out very quickly, just as a coincidence of timing. But all I'm saying is there isn't going to be as much of those assets that an individual investor is going to be able to invest in, because they're going to get bid up by these huge aggregators of capital who are already stepping into those transactions. So anyway, those are my kind of key things looking forward in terms of product type. We're bullish about industrial. We like self-storage. We are very intrigued by and are doing some conversion of office to residential in some key markets. We like the long run possibilities for assisted living, senior housing investing. And the reason for that is the demographics are overwhelming, and there is no way we're going to be able to build enough product to handle the demand that's coming with essentially my cohort, if you will. So those are things we're very excited about. You know, I think that multifamily is going to have to be selective, especially as it relates to new development. But I think there's going to be opportunities to buy things at a very good value. And the best aspect of owning multifamily is you don't have single tenant risk. You don't have that big user like you do in an office building that if they leave a floor, you've got a real hole to fill. So that is a form of diversification in and of itself. So that's everything I've got. I don't know if we've got some questions, Mike.
Yeah, Dan. First question that came in: whenever you're generating an individual investor is generating their investment strategy and determining between cash flow opportunities versus appreciation of opportunities, what are some of the things that they should keep in mind?
Good question. We see investors coming to us in one of two buckets. They're either concerned about keeping money working and being tax efficient and not churning, if you will, and paying tax every 3 years or something like that, and focusing on long-term cash flow. We see that as one bucket, and we see also a large bucket. For us, it's been the larger bucket, frankly, of people who they want to make sure that they're going to get in and out of a project in a reasonable period of time. They want to touch the money and see it again. And I would tell you that I think it's really more about personal preference and your aptitude to accept long-term risk. So we're in some projects, for example, I don't think we'll sell ever, that the investors in those will get handed down, generationally. And we have a lot of assets where the best value creation happens when whatever the event is, whether it's stabilization because something's been built and filled, or whatever value we're bringing to the table in a particular project, it's never more valuable than it is on that day. In which case, selling that asset and paying the tax and moving on is to other investments, and continuing to invest in those kinds of cycles is a better run than trying to hang on to something too long and watching some of that value deteriorate over time.
All right. Yeah, that's perfect. Thanks so much, Dan. We did just have another question come in. Out of curiosity, what are some of the things that have stayed the same from the start of your career to now? What has significantly changed?
Well, it's lessons learned from being a workout guy is that it comes down to people. The first thing I would do when I assessed a project that was in trouble in some fashion is I would go to the operator, and you can determine pretty quickly, are they good people or are they not good people? Are they hiding from you? Are your interests aligned? And one of the things we strive to do in projects that we do is to make sure that the structure keeps everyone's interests aligned. And in the course of a workout, if you've got reasonable people who can look at the facts and say, yeah, this is really what it is, you can realign the deal in a fashion where everybody from that point forward is aligned. And an example of that would be, so we had some projects that we were foreclosing on at the life company when I was there. And the developer had no economics in the deal. They were never going to make any money. So why were they fighting us? And they were fighting because they had a huge tax recapture if they gave the project back. So what we did was we created a partnership with them instead of a foreclosure, where they were a partner and there were capital calls designed in that partnership that they couldn't make and were designed for them to not make, so that we could manage. Every year we'd have a capital call they couldn't make and they'd get diluted a little bit more, and we managed their tax event over 5 years. That created value for them from where they were standing before, and was how we were able to kind of get this project stabilized rather than having to go through foreclosure. So I get back to your question, which is what has stayed the same? There are good people and there are people who are going to fight you. And if you've got good people, you can be reasonable and you can work through things. And that's why picking your partners is, I think, the most important aspect to making investments.
Yeah, that's fantastic. Thank you, Dan. We did just have another question come in from Robert. How do you view cap rate in terms of risk and value add criteria? So how do you incorporate that into your strategy?
Well, that is one of the most difficult things when you're taking a look at underwriting a project right now. I can't tell you how many projects we see where the sponsor of the project that's bringing it to us thinks the cap rates are going to return to what they were a year and a half, 2 years ago. And frankly, we're just not going to see that again in my lifetime. And it was because of all of the free money that was available. It was all about COVID and all the rest of those things. And it's unlikely that, can't imagine a circumstance that's likely to happen. So what we're doing now is we're returning to what is the historic norm in terms of cap rate ranges, as opposed to what was happening before. It wasn't the norm. That was very abnormal with respect to how cheap money was. What we're finding now is, and as we moved through that process, quickly changing interest rates and cap rates that follow, but they lag, is that that we're finding the new equilibrium, and the gap between buyers and sellers is narrowing as people are coming to accept that this is a new normal. So I would say that if one looks at a 10 or 15 or 30-year historical kind of cap rate range when they're looking at something and saying, where does this fit in that scale? Things always kind of return to the norm and to the mean. And that's what's happening right now with cap rates as well. So I don't know if that answers his question, but thanks for asking.
All right, and Robert, if it didn't answer the question, please feel free to reach out, and we'll be more than happy to address it in greater detail. We do have 2 more questions that just came in. Dan, can you kind of highlight some of the benefits and benefits of working with a family office partner, as you referred to previously?
The benefits of working with a family office. So if you are a family office, or the benefits of us, for example, working with family offices as investors. I'm not quite sure I understand the question.
I believe it's in regards to the benefits of deploying family office capital, perhaps.
Well, I think that I can tell you what we've enjoyed about working with family offices and individual investors, and that is that we know them. And if we're dealing with funds as a source of capital, for example, it's a transaction. It's a negotiated transaction. It's a commodity buy of money. And it doesn't allow for us to listen to people and what they need at the kind of personal level, and make sure the investments that we're supporting or offering to them really fit with what they're trying to do. For me, it's a lot more fun dealing with the people.
No, that's perfect. And if that wasn't a clear response, please just let us know, and we'll be more than happy to address it as well. Next question we have from Jennifer. Can you talk a little bit about the lakeside at Amelia Island in Florida, and if you have seen other small community projects, whether or not they're assisted living or not, with similar models with the option for individual living space?
Yeah, so that project was we partnered with a longtime partner of ours for the development of that project. The owner of our partner actually lives on Amelia Island, which is where it's located, and so it was very personal to him. And he saw a hole in the market, and if I could just take a little sidestep, this particular individual is his name is Leo Wells. Some of you may remember the Wells REIT was the second largest owner of office buildings in the United States at one point. He's a very sophisticated, very experienced real estate guy. And we were actually on the site of that particular project during construction. And he said to me, "Do you know how I came to be doing assisted living projects?" And I said, "No, I never heard that story." He goes, "Well, my parents got old, and I had to find a spot for them in Atlanta, and I found the very best one, and I didn't know how to underwrite what was going on there. So I rented a room, and I got a walker, and I moved in. And every place I showered with my walker, I went to food with my walker, and I just asked people questions and listened. So I learned more in a week about that industry. So I have a lot of respect for people who get that far into the due diligence and relating to the people. So this particular project, where you have there is cottage homes, freestanding homes and duplexes that surround a more standard looking assisted living project with wings, with various different kinds of on the entire hierarchy of services. And we're seeing more and more of this in assisted living throughout the country. We're working with a large developer of assisted living nationally right now on some projects, and they're looking at the same thing. And the maturation of that business kind of coupled with the baby boomer aging is that these projects are being built now with the idea that they want people who are actually living there to make the decision to live there, as opposed to the alpha daughter, which is usually how that works, where it's the decision of last resort. And to get the people to move into these earlier so that they don't have to burden their families. And one way to do that is to have a lot of program that is for younger, more active. This particular company we're working with, for example, has a bar inside of all of their facilities where there's music and people dance and there's activity. And I mean, it's kind of fun to hang out there. The point being there is by moving, this is an area where the needs of people and the economic needs of the industry are matching up really well. By bringing in people to make decisions themselves, they're bringing them in earlier. That means they're there longer, they have less turnover. And if you have more than 50% of your residents in an assisted living project, a senior living project, that are independently living, you get better financing, you get more longevity of tenants, you get all of the economics of all of this, of the entire project work better on the operational side. It's easier to hold and attract employees, and because they're there longer, they're not just churning very, very old people. And so anyway, I don't know if that answers the question, but we are seeing a lot of those kinds of properties being built currently, and I think you'll see a lot more.
That's great. And if that didn't fully answer the question, please just let us know. But otherwise, we are at time. Dan, is there anything that you want to leave everyone with?
Well, I just want to thank everyone for listening in, and you know, this is you've heard a lot of one person's opinions on things that I've earned over a lot of years, and I hope that it's helpful to you all that are listening today. Again, I want to thank Camaplan. We have appreciated coming to know them, and we have a lot of investors with us that have been investing through their retirement accounts, and it's nice to have partners in that space who recognize the value of service orientation to helping us convert those dollars into real estate investments. But with that, thank you all, and that's all we have for today.
A huge thank you to Forterra, Dan, and Mike for putting this together and providing us the insight, their insight into commercial investments. And huge thank you to everybody who showed up, had great questions, registered, and will be watching this recording in the future. I hope you all have a great rest of your day.
Thanks, Brad.
Much.